I want to give you some insights, starting with the European economy in total. I think you all, and I read a lot of newspapers and get every morning Property EU newsletter. So give you some general insights before we start the discussions. First chapter, cheap oil and QE, supporting the whole recovery story on that. Recovery means if you start collecting these things from 08 or early 09, all the arrows go to the North Pole, whatever this means. So this is, again, where we see the positive environment for our whole industry. But realistically speaking, and this is, again, more from a, let's say, personal view, but still linked to a lot of the other researchers and economists, I think this is a borrowed recovery situation we saw the last 5 years, especially with the last boom or rocket or whatever this means called QE by Mr. Draghi. I think I know the story quite well, and you too, that the prices get higher than ever expected. The main question for us is how long will it take? And coming again, not pessimistic, but rational, say, look, the rent increase scenario for offices, what's a little bit more stagnating, rising a little bit, but the price get higher. Again, this is for sure not a massive sign for a bubble or whatever you call it, but the question is the bubble outside is for sure the money market bubble. And as long as this will not implode our industry, positively speaking, we have fantastic future, let's say this. The question is, where does the big boom, the black swan, really comes from? Ukraine, Brexit, Crexit, HSV exit next year? I don't know. But again, I think the ECB decision-making process, when I say Mr. Draghi weakens the euro, again, positive for European investors coming also to Germany due to currency hedging on one hand. On the other hand, I think this is, again, it's borrowed money we work with. This is not negative, but I'm not sure if it's for the next 2 to 5 years, it's really positive for us. All these things, all the figures quite well, 10 years treasury bonds and the inflation rates, nothing really happened. What's written in the textbooks anymore? So from the macroeconomic view, we are driving our car in a really foggy situation, in a positive foggy situation, but in a situation where we really have no doubt or we have no proof or whatever. Looking back in history, looking at our textbooks, a QE activity from a European central bank never happened before. So again, this is again where all our predictions are professional, don't get me wrong. We get more due to big data, more information, all these things. But I have my doubts, to be honest, that we will have the next 5 years a pretty shining environment on this. But again, I don't know where this black swan really comes from. Just some words on the European real estate markets in total. By the way, I was asked when I joined the breakfast this morning, I was working with Catella. I would say 60% of my time I'm staying meanwhile again in buses as a tourist guide in Barcelona last week and in Madrid. Behind me, British investors, let's say British investor, pension funds, whatever. Some Canadians are there. And I'm explaining them Europe and I'm explaining them Madrid. And it's a 1 hour trip through the Castellana. At the left side you see, at the right side you see, fantastic. Now let's go to the Urbanización in the southern part. No, just city center. I said, well, look, but no, thank you very much indeed. Same happened in Frankfurt with some Asian investors in the bus. It's much more a short walk. We don't use the bus anymore. It's the same thing in Berlin, looking Finnish investors, me explaining why Berlin is so attractive for Nordic money. So again, I wouldn't say that the history comes twice back, but it's the same story. On one hand, it's the same good old story in between 06 and 07, like most of here in the room reached. On the other hand, it's meanwhile so risk-adjusted. So I'd really tried to find, rational speaking, some irrational stories from investors who can't explain why they are doing this with the money from other people. And this again, where on one hand I see a lot of massive impact by all the risk managers. We saw rocket up starting in 10 and 11 in all the organizations on one hand. On the other hand, for me, most of the investments I saw and I collected the last, let's say, 2 years are rational. Whatever irrational means, by the way. I will mention this later on. From the general overview, you can see it, London and especially UK, followed by Germany and France, the most attractive cities and countries from from a global attractiveness index. You see the investment volumes, UK around 22 billion, followed by Germany 18 billion, and all these arrows go to the northern side of the structure. We see nearly in all sectors increasing all these things. But don't get me wrong, just why a market and the prices increase, it's not a sign of a bubble in total. The fundamentals, and this is again for me as an analyst, much more the most interesting part, show a wide spectrum within Europe. So from the German perspective for sure, and maybe also from the Swedish perspective, but not from the Spanish perspective and not from the French perspective at all. I think this is again where we should bear in mind all these figures. In total speaking, I think it's the sun is really shining out, and all these rocket up scenarios in Spain, let's say this, is for sure driven by the international money and investors going to these labeled as still undervalued country on that. This is nonsense for sure. It's Madrid and it's Barcelona from the office guys and more secondary cities from the retail guys and slightly logistic things, and that's it, total. So again, if you look on the fundamentals in Spain in these days, you see an unemployment rate of people who are under the age of 13 by 28%. This is for sure absolutely not positive. And this is again where you have to really look on which side of the medal you show in such kind of a presentation, generally speaking. Again, still a pretty shining situation. Cross-border investments continue to seek out of Europe investments Q1. So again, it's much more international money coming to Europe. I don't want to bore you with these things, but just compare all these, the main factors, the main countries here in Europe, UK, Germany, France, and the Nordics. You see then, and this is again where the structural effect meanwhile shifts France in a situation which is not really comfortable. I know there will be, I think next week, the anniversary celebration in Paris. Don't show the slides. But again, I think you read a newspaper and you are linked with the local markets there. It's for sure the Ile-de-France case. And I don't count a lot of investments in Marseille, Lyon, Strasbourg in these days. So this is, again, a massive focus on Paris, CBD, Croissant d'Or, and the towns. On the other hand, the Nordics, just one little story. We brought the Q1 figures together, and there was a massive decline in investments in Finland/Helsinki. And again, always re-ask these changing things. So Thomas, it's quite simple from your Frankfurt warm office. It's the sanctions. We see, meanwhile, measurable between Russia and the EU or /Finland on that. On one hand. On the other hand, if you look at the residential sector, you see a massive rocket up. And I say, what's that? Are these Finnish people who make more investments in housing and all these things? I say, no, Thomas, these are the Russians buying housing out of Russia. Though, again, it's always the question, what's behind the headlines on that. Again, also from the regional trend, we see much more money coming also to Germany, but more or less also to UK and Nordics. Some words on the submarkets: office, retail, industrial, residential, and hotel. Again, the same story. Again, don't want to bore you. All sectors in Europe saw an increase in investment compared to Q1 last year. And looking back in my explanation last year, Q1 last year, it was the main question also on these audiences and panels: how long will the rally goes on? Well, now we left 12 months, and I have absolutely no doubt, except Black Swan from Mr. Whoever will be, I have no doubt that we will see a fantastic Exporeal, and maybe then a more or less fantastic MIPIM 2016. So again, the forecast for the next 12 months is fantastic. On the other hand, I said we are driving a car in a foggy environment. And this is, again, where the risk, for sure, increases dramatically in our understanding as analysts. Don't get me wrong. Look at the top view and look from the bottom-up view. Again, the strange stories for investments I don't hear anymore, but I see that the prices for property rises higher than the rents. This is not a bubble, but this is, again, one of the more or less one of the main signals we see that the market become to a much more hotter situation. On Monday, we will launch a press release, not we, but the GIF, where I'm part of the board. And there will be, is the 3 already on the horizon? 3 means the office yield, 3 point something. I think also from Uninvest, all the German researchers are part of the consensus survey, and with fundamentally 98% convinced. Yes, we see the 3 something coming for the next 12 months. Is all these predictions from us really comes to a positive end? Capital flow, I think, interestingly speaking, in this positive environment, you see more people moving from Jones Lang to CBRE and from DTZ to wherever, and to some to Catella, and you see a lot of IPOs. You see a lot of M&As. You see a lot of these things make the world much more happier and shinier for advisors, for investment banks, and all these things. So again, I wouldn't say this negative, but let's say the Klépierre case. In this case, this was the biggest transaction or M&A. Say this, we saw the last 12 months, and so this is again why we see a lot of things going much more on the positive side. We heard last week on from Horizon Group, Israeli investor. We heard this morning by Property EU from the IPO views from another company listed in Tel Aviv. We see the Chen family coming over to Europe. Chen family, a massive Hong Kong-based Asian family looking for these things, US-based / Hong Kong-based family. So we hear new names. And this is again where this is a typical sign for an absolutely booming market where a lot of new competitors, say negative, come to the market on that. Just one single slide on the housing market continues to gain momentum. This is a typical German boring headline. It's a fantastic situation what we see the last let's say 3 years going on that. Patricia make really obviously a pretty good job by acquiring everything, let's say this, speaking provocatively. No, but I think from a European perspective, it's still an absolutely hotspot what's going on there. And also the Swedish, Catella, Sweden starts developments in Düsseldorf, surprisingly, after 32 years of never again, our failure in the late 80s. Well, it's market. What do we see here, looking on the fundamentals, total return, it's over 6%. Average Europe. Main push factors is urbanization, security, doctrine, I call this, and for sure the money market bubble. Let's say this. It's always interesting when a real estate guy say, no, we have a slightly bubble. Their bubble is bigger. Maybe this is for sure the black swan. I have no idea where it comes from, but this is again where on one hand it's positive for our industry, but negatively speaking frankly and open to you, this is the main thing where maybe quoting some stereotypes, a Russian came just around the corner and say, I bet for 10 billions more for that property. This is the market in these days. Yield range shows a wide attractive spectrum for sure. And again, the M&A expected next quarters, maybe before summer break we see the next one. But I'm absolutely convinced that during Expo Real we will see the next big bang from a German/international consortium like this. The long-term challenges for going in housing, because it's so easy acquiring housing. Energetic requirements, mainly driven by all these things going on with the GC, but also on the Kyoto Protocol. Energetic requirements, this will be the main capex destroyer for all of us. Investment in these things. Demographic development for sure, and especially maybe in Germany, but coming a lot of these other countries, same situation. Integration of immigrants. This again where I think we have to find a solution as one European family on that. You can for sure read later on the attractiveness of all these things. Again, Germany and the Netherlands are attractive. Germany much more driven by these expectation of higher prices, and the Dutch housing market more attractive coming from the liberalization of Mr. Gute, let's say this. Again, first sum up from the European perspective, Draghi weakens the euro, quote by me. Speaking frankly and open and really absolutely rational, the role of Mr. Draghi is standing at the line as a referee, maybe here too, and not make a role as a player for both teams. And this is again where, forget all the textbooks, we never ever had such an experience. So this is again where Draghi weakens the euro, but again, positively speaking, because the press is here today, this is for sure the main big pushing factor for our industry. And as long as I'm working for a company and you too, it's always better to see that Mr. Draghi is a good guy for ours. Growing attractiveness for office, retail, and residential in first-tier cities, for sure. This comes now to an end. The yield should come down at the new level, whatever new means on that. In Germany, it's the famous 3-something. Again, I have my doubts, to be honest. Maybe that the sentiment becomes more on the 3-something. I see it still that we maybe stop at the 4.25, something like that, for 4 quarters, something like that. And from the Asian game, this is again a thing where we see, meanwhile, measurable. This is in contrast to the evolution we saw between 04 and 05, last decade. Meanwhile, we can count nearly on a weekly basis investments within Europe. Italy last week, Frankfurt, Munich. I think it's 4 weeks ago, the big Siemens campus with Ginkgo tree. So all these things, for an analyst, it's my boring job. I just count all these things, and the Asians are here. They are here. They make investments, and again, we can count them on that. And from their perspective, they tell us the same story like we told, let's say, 8 or 15 years ago. We go to Europe due to diversification reasons. If you talk, for sure, I think some of you also talk to Asian investors. The Asian-Australian case, it's now over. The US case for them, it's over, so they come much more to Europe due to diversification reasons, and this is, again, the main story on that. The second story is there is a huge lack of pension funds, mainly in China, so all this money flow will explode when all the state funds and all these sovereign wealth fund comes, again, globally, and they are on the same risk curve, let's say, like Union or the other ones. And this, again, where competitive increased dramatically. So new players are on the market, and we don't see others vanishing in that case. And this maybe will one of the main triggers why we see rising or falling yields on that. And again, due to the persisting high demand in Europe, real estate markets, the rents are predicted to rise slightly in 2015. Just sum up with some general words on Germany. Now you see that the arrows show much more on the southern part. Positively speaking, except of one thing. It's just a little shot, let's say this, transaction volume compared to Q1 15, compared to Q1 14. This is a slight decrease due to the, let's say, postponement effect of a lot of decisions going on. But generally speaking, it's a positive environment. The prime yield now at 3.50. Prime yields, High Street 3.9, so around 4. Office average also on B locations, it's around 6. Retail around 480, sorry, of that, and 6. So again, the big picture hasn't changed, to be honest, but please see the arrows that we see a further increasing on prices rather than going down the yields. Cross-border activity, and this is again where I think we should really have a much more closer look in our daily work. You see on the bottom cake, you see a Q1 40. So the foreign investors has an attractiveness of a share of let's say 40%, and this is compared to this last quarter Q1 50. It's rocket up to have to say by around 60%, and this is again where we see more international money coming to this market. On that, for me, the sentiment is quite simple. I told you the story as a tourist guide in Frankfurt. Where sounds funny, but I see more things coming January, February this year from Canadian Canary Wharf inhabitants, from big investment companies. We need more information on secondary and third-tier locations. Thomas, do you have something in place? For sure, we have that, and this is again a sentiment for me that obviously the investors are looking for a kind of a next level of, let's call it, strategy on that between Freiburg and Kiel. On the other hand, I don't really count a lot of these external money in the B and secondary locations, to be honest. So this is again, but if the sentiment is not wrong, we have to expect more of these interesting stories, again, in Darmstadt or wherever, from international money. Again, another strong year for investments with ongoing demand for prime office and residential space. I think these are the big two columns for the investments in Germany. Growing interest in secondary locations. Again, all these Hanover and Freiburg and Karlsruhe. You'll see further compression. Okay, I mentioned this. I don't see the 3 by Expo 3 point something. I am still a believer on the 4 something due to the interest rate side. But again, it's back. Increasing risk tolerance for investors. I think this is the most funny word. You know what this means. we see more. We accept more risk on that. And this is again the story, telling your investors as a pension fund, well, the 5 is something, yes, this is in the contract, but we can deliver you with the 5 something. Again, speaking frank and open, it's workable to be honest, but I think the yield will come much more on a level something around 4. Growing cross-border activity due to attractive yields on that. It's always important to hear the story from the other ones, why they make investments in Germany. They are absolutely rational, don't get me wrong, but it's nearly a similar situation. And the rising demand and lack of suitable supply will lead up to upward trends in prime rents. On one hand, I think when you're all in Hamburg, but also in Berlin, we all struggle a little bit with a lot of gridlocks due to construction sites. We have an absolutely lack of new developments in Germany. I have to mention this, just seeing on the pipeline and not on the quarterly level. This is in line with that. There is a huge lack on these things. This is again where maybe we can also have a discussion going on.